It's against the grain, it's unconventional, it's un-American, some would say. But yes, you can play the market to the short side, and one way to do that is with long puts. So let's unpack everything you need to know about the long put strategy. Hey, Jim Schultz here for F-Cubed and Live, fcubed.com, and let's talk about a buying put options strategy. And to work through all the details in this video, we're going to be using this long put option in NVDA in the March cycle. So hang with me through this whole video and we'll break down all the important pieces of this NVDA put option. Now, NVDA is one of the hottest high-flying tech names in the market right now, and they actually have earnings coming up here in just a few days on Wednesday, February 21st, 2024. So while the focus of this video is not on option strategies for earnings, it's not that at all. I want to stay focused on these long puts because NVDA earnings are coming up, and because I know many of you out there might be trading NVDA earnings next week. If you guys hang with me to the very end of the very end, I have a little bonus section for you all about strategies to consider or maybe not to consider going into earnings that will likely change the way that you view trading and earnings and options in general. But first things first, let's dive into this put option example. And I want to set this video up the same way that we did our call option video using the Tesla example. And I will link to that up in the cards and down in the description if you haven't seen that guy yet. And we're going to be able to move through this video a lot more quickly because a lot of the option contract characteristics and features that we needed to know, we covered them back in that long call video. So I won't do that again here, but definitely reference and check out that video below in the description if you haven't seen it yet. So with call options, as we've already seen, the long call buys shares from the short call if the option is exercised. Okay. With a put option, that all changes. With a long put, you now have the right, the opportunity to sell shares to the short put at the strike price. And this is often quite confusing for newer traders because you are long the put, but you are essentially short the stock. You bought the put, but it's giving you the opportunity to sell the stock. You want the value of the put to rise because you bought it, but the best way for it to do that is for the stock to fall. Whenever you buy something in the market, you are long that something and you want its value to increase. Whenever you sell something or short something in the market, synonymous in this scenario, you want its value to decrease. Hence, you are long the put but short the stock. And if you're on the other side, you're the short put, you are short the put, but you are effectively long the stock because you sold the put to the long put. Again, remember to always think of the contract as a transaction between the long side and the short side. So if the long put ends up exercising, you will end up buying the stock as the short put. So here you are short the put, but you are long the stock. Now, you might want to replay those last couple of minutes a couple of times because that's not super intuitive and it's probably going to take a time or two or 26 for that to really sink in. Not to mention, your boy needs that YouTube watch time. But the key to understanding the core essence of a put contract, especially from the long side of that contract, as we're going to see with this NVDA example in a couple of minutes, is essentially this. Remember that the strike price of the contract is fixed over its life. It is fixed up until that day or point of expiration. So at any point as a long put holder, I can sell shares to the short put at that strike price. So hopefully from that alone, you can see why you want the stock to go down. You want it to go down because if it does, you can buy the stock for some price down here and then sell it up at the strike price at some price up here. And of course, the further it goes down, the more valuable that put contract is going to be to you, the long put holder. Okay, so let's now take a closer look at that NVIDIA put option example that I referenced earlier, and let's do this inside of the tastytrade platform. And again, just like we did with the long call and the Tesla example, let's just assume that we're holding all of these options to expiration just to make the discussion and the analysis a whole lot simpler. So here we're back inside of the tastytrade curve view, and you can see we're looking at that NVIDIA put option. We have a current stock price of $7.31, and the option we have here is the 700 strike put, expiring in 29 days, the third Friday in March, and it is selling for a whopping price of $34.75. So if you want to buy this put, be the long put, then you have to pay $34.75 per share, or a total of $3,475 since the contract is for 100 shares. So first and foremost, you might be thinking, whoa, baby, that is a huge price tag. And it is. But the reason why it is so much, the reason why that price tag is so high, is because NVIDIA is a highly volatile stock. So if you get the move in your favor, which in this case, of course, would be lower, man, you can really cash in, because this stock can easily move $10, $20, $30, $50, $100 in a day. Just last summer, when NVIDIA had earnings, the stock moved $100 overnight from the NVIDIA earnings call just last summer. So in stocks like this, NVIDIA, Tesla, SMCI, etc., big moves are always expected, and they're priced into the options. Okay, so let's suppose that you buy this option. First things first, here's what I want you to see, and here's what I hope you can see. The current price of NVIDIA is $7.31. The strike price on this option that we've set up is $700. So my question to you is this option helping you right now? Does this option put you in a better position than you would be if you didn't even have it? Hopefully you can see that the answer is no. It is not helping you at all, at least not yet. Remember, by having this option, whatever you pay for it, $34, $4, $100, whatever, you have the right, the opportunity to sell shares to the short put at that strike price. Well, the strike price is $700. The current market price is $730. So why would you use your put to sell something for $700 that you could just go into the open marketplace and sell for $730? Right? Nobody would do that. So this option right now has no value to the long side, to the long put holder. Okay, so it's not helping you now, but could it help you later? Yes. If NVIDIA does what? Goes down. Goes down below that 700 strike. And the further it goes below the 700 strike, the better it's going to be for you. So as you can see back on the curve view, your profits grow the further NVIDIA falls below 700. If NVIDIA falls to 675, that's good, because you could buy it for 675, then exercise your long put to sell it for 700. That's valuable. If NVIDIA falls to 650, that's even better, because you could buy it for 650, then exercise your long put to sell it for 700. Very valuable. And if NVIDIA falls down to 600 before the third Friday in March, that's even better than better, because you could buy it for 600, exercise your long put and sell it for 700. That's extremely valuable to you as the long put. So hopefully you can see how with this long put contract, you are very clearly bearish on NVIDIA. All right, but what if it doesn't work out? Right? What if you're wrong about the direction in NVIDIA? What if NVIDIA goes up and it never gives you an opportunity to cash in on the downside? Well, remember that you are under no obligation to use this option. You have the right, the opportunity to sell shares at the strike price, but you are not required to sell shares at the strike price. So if NVIDIA rises and the put contract is not helping you, you simply let it expire worthless. Right? You lose what you paid for it, which would be $3,400 in this case. So don't get me wrong, that would probably sting, but it's still the most you can lose. It doesn't matter how far NVIDIA rises, it's all the same to you. You'll be out the premium you paid for the option and no more. And lastly, just like we saw with the long call example using Tesla options in that call video, there is a point where you break even on the trade. This point is where the profit curve crosses up over the x-axis, and it's going to be equal to the strike price minus the cost of the option, or $665.25 in this example. You have to cover your cost of what you paid for the option before you have any positive profits on the trade at expiration. And just as we saw with the long call video, there are essentially three main points that you want to remember and walk away with. Number one, your profits on a long put are essentially unlimited. Yes, they're technically capped at 0, but it's not too often that companies go down to 0. So you essentially have unlimited profitability. Number two, the maximum loss is capped. Again, if it doesn't work, you just walk away. If the option is not giving you any value, you just let it expire worthless and you lose no more than what you paid. And then number three, of course, you are under no obligation to actually use the option. You are under no obligation. It is not mandatory that you actually use the option. You can always just walk away. So now my hope is that by working through the basics and going through the NVIDIA put option example, this is all a little bit clearer for you, a little long put options explained, if you will. Quick little shout out to the YouTube algorithm. But now, here's the bonus NVIDIA earnings call content that I promised. So going into the earnings call next week, you might be thinking, man, bullish, bearish, whatever. You're like, man, I'm going to cash in big on this earnings move, and I'm going to use options to do it. So you could use a long call like we did in the Tesla video, going through long call basics, still linked down below, by the way, if you haven't seen it. You could use a put option, a long put option like we just went through with NVIDIA in this very video. Or there are so many other strategies that you could consider. There is no shortage of different earnings strategies and option strategies for earnings that you could consider, whether it's NVIDIA earnings or Tesla earnings or McDonald's earnings or Chipotle earnings or whatever. There's so many different things that you could consider. But here's the cold, hard truth. Buying premium in the form of a long call or a long put is probably one of the worst strategies that you could choose. Arguably, this is for a lot of reasons, but let me show you one. So here we have something similar to what we just looked at with the March put option example that we basically spent the lion's share of the video on. But here we're just using next week's cycle that expires right after earnings. We have the 7:30 put lined up to buy. And don't worry about the cost of $41, which of course is 41 option dollars, which means it's 4,100 actual dollars. Don't worry about that. Don't worry about the max profit. Don't worry about the max loss. Don't worry about any of that. Just look at the probability of profit, the pop, 37%. That is the probability that you will make 1 penny or more when this option expires. It's less than 50-50. It's way less than 50-50 actually. So not too promising. Now you're probably thinking, wait, Jam. Are you crazy, my man? Are you crazy? Have you not been following the market? Have you not been following the video? There is no way that I'm playing that thing to the downside, my brother. That's crazy. I'm playing the video to the upside. So show me what that looks like. Well, here you go. So here with the stock price about the same, I grabbed these screenshots a few seconds apart. Look at the 7:30 call option. It's even worse. Now you only have a 33% pop, even further below 50-50. Yikes. So even though NVIDIA going higher or lower from here is about a 50-50 shot, and we've set up the strikes on both options to right about where the stock is right now at 7:30, the probabilities on both trades are both quite low and nowhere near 50-50. So why is that the case? Well, it's essentially because, remember, in order to be profitable on this trade, you have to cover the cost of your option, regardless of whether it's a call or a put. So until you can jump over this $45 hurdle on the call side or the $41 hurdle on the put side, you won't be profitable. That makes both of these trades less than and way less than a 50-50 shot. I mean, is that not kind of crazy? I mean, I've been looking at this stuff for over 20 years now, and even I'm shocked sometimes when I actually look at the hard stats. It's not based on my opinion. It's not based on your opinion. It's not based on your favorite prognosticator's prognostication. These are the cold, hard, objective probabilities of the marketplace. So naturally now you might be thinking, well, wait a minute, Jim. Does this mean that buying calls and buying puts is always a bad strategy? Now, look, I want to be fair. I'm always very hesitant to label something as bad. So instead, let's call it an awful strategy. So then, of course, you're thinking, Jim, why did you take 16 minutes of my life that I'm never going to get back going through this long put example? Well, you should never discard something in anything in life, but especially in the markets. You should never discard something without having good reason for discarding it. So when it comes time for us down the road, which is coming, by the way, to dismantle these long options, I want you to understand fully what we're dismantling and why we're dismantling it. But again, that's all coming down the chutes. In the meantime, don't forget to like, share, subscribe. All those things would be amazing. I appreciate you guys so much, and I'll see you guys next time.